Thank you for joining us, ladies and gentlemen. We are here today to talk to the CEOs of some royalty companies. They're going to try and argue the case why royalty companies should be immune to market conditions. So I'm going to kick off with Brendan Urich, then Dave Cole, and then Frederick Bell, who are going to give us a romp through the world of royalties at the moment. So Brendan, why don't you kind of kick off, tell us a little bit about your company, and then I'll go to the others.
Sure. Thanks for having me, Matt. I'm Brendan Urich. I'm the CEO of Electric Royalties. We are a young royalty company focused exclusively on those clean energy metals required for the transition to clean energy. We've got a portfolio of 19 royalties, really targeting those deposits in North America, Australia, and Europe that could be a domestic source of supply of these metals moving forward. We've got cash flow, 19 royalties, a lot of catalysts coming this year. Stay tuned. It's going to be an exciting year.
Mr. Cole, what about you?
Thank you, Matt. Pleasure to be here. Dave Cole, founder, CEO, EMX Royalty Corporation, ticker symbol EMX on the New York Stock Exchange. And we love royalties. And we accumulate royalties through the royalty generation process, which is prospect generation focused on the royalty component. Happy to talk about that, as I always do. We also buy royalties and royalty portfolios, and very pleased to see significant development of the portfolio over the course of the last few years, and some great events that are forthcoming in the very near future, Matt.
Fred.
Again, thank you for having us here, Matt. I'm Frederick Bell, the CEO of Elemental Royalties. We just announced very recently a merger with Altus Strategies, a merger of equals to create a combined company that has 11 producing royalties, diversified across 13 jurisdictions, 75% weighting towards gold still. But it really gives us critical mass scale to go forwards. And I think this year, clearly that will be a really foundational moment for the company and due to close in Q3.
Fantastic. Okay, gentlemen, let's answer that question, which is, each of you have told me at different times that you guys outperform equities over the long run. Doesn't look like it in this market. Brendan, what's happening?
Yeah, well, we should be. That's the crazy thing, right? Royalty companies are perfectly placed for this type of environment. We are protected against operating cost inflation because our operating costs are zero. Once we've paid our upfront capital, we have a right to that cash flow. It costs us nothing on a unit basis moving forward. We're immune from capital cost inflation because we don't have to contribute any of that cost. If I look at our own portfolio, we've probably had about $400 million or more put in by third parties at no cost to us over the last year and a half. And so, we're perfectly situated like that. I think the key piece is really about pricing and our expected revenues, right? For our case, we look at lithium. Lithium prices were up 500% last year. That means our expected revenues are directly proportional to that increase. So we'd expect our expected revenues to go up by 500% across our lithium portfolio. So that's pretty good hedge against inflation. I'd say that it's, probably done a little bit better than gold. But I don't want to pick apart that in this discussion, but we should be. What you're seeing though is we're all beat up. I think there's a real problem with, the actual accuracy of investors to be able to, earmark what valuations are in this space. Part of that being that we have so many assets, it's much more difficult for investors to go through and individually vet those. But diversification shouldn't be a negative.
Dave, so what do you think is happening? You've been 19 years at EMX, which company you founded. You've maybe seen a couple of cycles in that time. Is this any different to the others?
Well, each one's a little bit different, but we're in a highly cyclical sector, of course. But let's talk about the history here a little bit. If you go back and look at the valuation of royalty equities as compared to producers and explorcos over the course of the last decade, and particularly since the point of last market capitulation in January of 16, the royalty equities have done very well. The senior royalty companies and the junior royalty companies. And there was a phase there where the junior royalty companies were quite in vogue. A lot of people were looking for the next Franco-Nevada as an example. And the junior royalty companies behaved very favorably, had strong alpha performance. And then we have seen, in my view, a very healthy correction and consolidation of share price over the course of the last now almost 2 years. And, I believe Brendan's correct that that's creating a buying opportunity for astute investors to come in and look at. But let's be honest, there's been a lot of bloviation within the space, and investors are saying, wait a minute, not everything that we've been told has come to fruition. And so that's correct that there's been a pause. And I think in the next leg, as we move forward, real assets will perform nicely.
And what about you, Fred? You've just announced the Altus deal, which I think, normally the market would have welcomed. It brings together two, good companies. But the reaction to your stock price would suggest that maybe they just don't care. I mean, how do you feel about that?
Yeah. I think it's actually, I think building on the theme to some extent that Brendan and David were talking about, we listed the company, took it public in the middle of 2020. I think we started trading on the 30th of July. And I think the sort of high in the market was one day sort of on either side of that. So we really came in as the market in mid-2020 was at its peak, and we've seen it not just come off since, but we've seen the second point that Dave mentioned, is which we've seen if not a flurry of new royalty companies, certainly a whole, I think, sort of treadmill of new royalty companies coming on, and that combination of the markets weakening with more companies in there, and also in buoyant equity markets, typically not as many royalty deals get done, or if they do, they don't tend to be as good because the environment isn't as good. So I think for us, it's been quite a almost 2 years now, quite a interesting period to go through. And at the end of 2021, we had a hostile takeover bid launched against us. That didn't succeed; it fell away. Subsequent to it falling away, we then announced a merger just recently at PDAC with Altus Strategies. And really, I think one of the main aspects that we saw that was appealing, or we thought did make sense through the hostile discussions and bid, was consolidation, and that partly drove, I think, probably speeded up conversations we were having elsewhere, the merger we announced with Altus, it's really a merger of equals. It brings in two companies. Both have some really good quality producing assets in them to give a really strong foundation, but it just means that it is a company that is more, it has an enhanced capital markets profile, and it is more relevant for investors. It's easier for investors to invest in it. It should have greater liquidity. It's got a bigger, more diversified portfolio. It's got a bigger team with more experience across it, and it's got an even bigger shareholder base. So, I think that fits into the theme of what has been discussed over the last year in the royalty space, and what we just started talking about in the last 5 minutes.
It's funny because we actually also went public around the same time that Fred did. And now our share price has just dropped, below where we went public at, despite us, we're up to 19 royalties now. I think yesterday we were actually trading with an enterprise value of about 5 million, across 18 royalties. So, it can be frustrating, as we've been growing, keep adding assets. I know Fred's had a couple transformational deals over the last couple of years. And each time the market should be rewarding these things, and people are getting hit. And I think it's just a lot of that is to do with timing, and people, getting kind of spooked in this market. But there's a lot of value being built and created in these companies that's being overlooked at this moment.
So what do you do about it, guys? Because each of you is telling that story, but each of you got a similar share chart. It's heading down. It's risk off. It's absolutely risk off. But you guys have got long-term time horizons to your business plans, business strategies, right? So do you need to behave differently, or do you just think, look, it's just a moment? This is, we've got counter-cyclical strategies, or we'll sell something, we'll take advantage and buy something. I mean, how do you come at it, Dave? What's going to make a difference?
The bad capital markets, or capital markets that we tend to bemoan, are the norm within the natural resource sector. We're more commonly in those markets than we are in robust markets, and we have to think countercyclically. We have to be prepared to weather those timeframes. This is a time when EMX, as a royalty generator, will be staking lots of claims and acquiring exploration licenses to drive our royalty generation profile forward, because that's the most astute allocation of capital. And, if and when possible, looking for royalty acquisitions that make sense. But as the gentlemen have pointed out, purchasing royalties is a tough business, because people know what phenomenal financial instruments they are.
But do they? Surely if they knew that, they'd be rewarding you. They're not rewarding you.
So you're making a key point. So I'm discussing the actual marketing processes which sell an individual royalty to those of us on this call as well as others, as opposed to the valuation of the companies, right? So what we've seen is that the valuation of royalties being sold remains strong because everybody wants to own more royalties. And we all know that the more royalties we own in our portfolio, because of the portfolio effect, the more the whole portfolio is worth, which is why Frederick's merger, I believe, makes great sense. They can become larger. They've got a larger portfolio. They should have an uptick and a repricing associated with that after we get back to a more normalized market. And I applaud that merger. But coming back to the point, the individual royalty sales remain robust with respect to their valuation because people want to own royalties. They know that they are excellent inflation hedges, and we're in an inflationary environment. They know that they have phenomenal optionality that are embedded in those instruments. And so everybody wants to own them. It's been that way for a long time. And but the companies that have been going forth and building these portfolios are seeing a consolidation. I personally think it's healthy. We'll all come out of it better at the end of the day. And Frederick's example of a merger of equals is one example of a betterment probably within that portfolio, and to mention that again. But there'll be others within that. When we look at it ourselves, and because of course, been a plethora of offers for us to merge or be acquired by different companies, and we do a comparative analysis, and we say, hey, the most astute allocation of capital for us, and of course, issuing shares is issuance of capital. The most astute allocation is to push our generative business at this point in time.
Okay.
I'll just say that, look, we all have very low G&A. That's the nice thing about royalty companies. We just announced a sale of a partial royalty. We're gonna have about $8 million cash pro forma. That could get us through till 2028. If we needed to, probably even longer, because we're going to be cash flow positive in a couple of years. So, honestly, if we just waited and did nothing, our portfolio is going to grow and create a lot of wealth on its own. So, we don't have to do much. It doesn't cost us much to run these companies. So, it's a nice place to be. But there's a lot of opportunity out there. I think in this market where companies are having trouble raising equity at decent valuations, that's exactly where a royalty makes a lot of sense. So for me, I look at the opportunity as creating new royalties, not acquiring existing royalties out there, but identifying those deposits you want to be a part of, offering them capital in this market. That's for me is the way to go, and I think there's a lot of opportunity right now, and there's going to be more over the next kind of 3-6 months.
Do you agree with that, Fred? Because you've made a big move with Altus, right? That's a big move, and you didn't get rewarded for it. So what's your message to whether it be your shareholders or people looking at you? It's like, remain calm. We're building the fundamentals of the story here, and you will be rewarded at some future date. I mean, or do you think, actually, I got to adjust my strategy somewhat, and I'm going to have to do something which may get a better reaction?
Well, it's you made an interesting comment earlier, Matt, in when you said you're sort of in this position where the equity markets are weak, and everyone's share prices are off. And how do you think about it? Well, we think about it in we have been, in the sense that we've been waiting for this moment, and couldn't be more excited for it. Again, we listed when the markets were at their peak, and deals that we had been looking at, instead of looking at them at $1,600 gold, people were wanting $2,000 gold. People who had been looking at a royalty versus equity were then looking at a record share price and saying, we'll go and raise equity. And so actually, a lot of opportunities that we'd looked at and seen either didn't make sense or for one or the other party, or it was not at a price that we could get comfortable with. And so actually the whole in Elemental's case, and I think there's similarities with both Brendan and David, but in Elemental's case, what we really focused on at the beginning was diversified revenue. And the merger with Altus gives that. I mean, we're getting up to just under $20 million adjusted revenue for this year. And what that does is it gives us an ability to deploy capital in the bad markets when we don't necessarily want to issue new equity, or we want to limit the amount of equity we can issue. And the whole thesis behind Elemental was we started this company privately in 2017 on a shoestring budget, with producing royalties from day one, so we were cash flow positive and we could be masters of our own destiny and avoid getting diluted massively in the bad years. And so, since we've listed, I'd say it's been the best years since we started Elemental. And so now, coming into a market that is weakening and coming into a market where share prices are off where they were in 2020, that gives us a great opportunity to not just do new deals, but to revisit some of the deals we already had there. And so I can't wait to get this merger with Altus closed and for us to be able to go out and target some of those opportunities, which in some cases we've known about for a while and sort of, I think, waiting for the right market environment and opportunity to be able to execute on.
So that you can take advantage of the fact that some people may be a little bit more cash constrained and more likely to do business, and obviously that new revenue profile, if you will help. So does that mean the days of using equity are over in the near to short term?
It's always a balancing act. I think a few of the royalties we've bought, part of the attraction for the vendor was actually becoming a shareholder and being benefiting from that. And so a few of our transactions on the Wang Yon royalty and on the South 32 portfolio, both of those royalty owners became significant shareholders in Elemental and remain significant shareholders in Elemental, as well as taking some cash. So I think it can be a mixed approach, but I certainly think that it is helpful to be as cash flow positive in a difficult environment as possible.
Right. And Brendan, you've obviously, I think you did the Seymour Lake royalty deal recently. Was that a kind of a defense mechanism, or was it literally taking advantage of high lithium prices and saying, actually, let's get cashed up?
Yeah, well, it was just about a valuation thing. We have 19 royalties. We have a producing royalty that's spitting out about $500,000 this year. We've got a lot of different royalties. We've got Battery Hill. They just put out a PEA, showcased the 47-year mine life. They're going to have average US 177 million revenue per year, and we're going to have 2% of that, gross off the top. So we've got a very good portfolio, but we were trading, yesterday with an enterprise value of about $5 million, spread across that, across 18 royalties that we have. So for us, it was about kind of proving to the market that there's some value to these royalties. We picked that up last year for about 1 million in shares. We've sold it now. Part of that, so we still maintain exposure, but at a 6 million valuation. And so, that combined with our cash, is just really, we're not getting value for it in the market. We thought the cash today, we can go deploy that into some nearer term deals. But, that asset is a perfect example of the growth and value before cash flow. We picked that up when it was an earlier stage project. They've had now about 55 or so million dollars come into it over the last kind of 9 months. And so as they're developing, that value goes up, along with metal prices as well. So you've seen lithium prices jump 500%. That's where you get that kind of bump in value. We just felt if the market's not going to give us that today, we're going to, monetize part of that. Hopefully they give us some of that credit for cash.
Right. But given what everyone seems to be saying to me, which is now's the time to take advantage of a market like this, if you've got the cash, are you planning more sales, or, can you do acquisitions in this market? I mean, what's your position, Brendan?
Yeah, well, we just did announce the copper royalty deal as a new royalty that we're creating. We picked that asset out of many assets that we've looked at. And there's lots of deals like that. I think there's tons of opportunities. Historically, we've used shares as a major part of our acquisition cost. We're definitely going to be shifting away from that, given our current valuation. But, to Fred's point, I think it's more about, you kind of play it by ear. You have options, we have tools to use. And it just really matters, where you are in the moment. Right now in our moment, our share price is so low. Our cash is definitely going to be a better tool for us to use to grow, potentially co-investment as well. But, we wouldn't be looking to use shares as our acquisition payment now. Although there are certain vendors, certain deals you couldn't get done without that, where to Fred's point, these guys are coming in because they want to have that exposure, ongoing exposure to that royalty moving forward.
Right. And Dave, you sound cool, calm, and collected, a bit Warren Buffett-like, in the sense that you see this market as a great opportunity for buying, additional royalties. But how do investors look at this? Is this a good opportunity to be buying companies with strong fundamentals? I mean, what's your pitch to shareholders?
This is a common discussion point, and it focuses on the difference of the common investors' outlook, which is what will happen by the next long weekend, versus what's happening in the overall global mining sector. We anticipate that copper consumption on planet Earth over the forthcoming 20 to 25 years will equate to the cumulative amount of copper that's been produced and consumed on the planet throughout all of human history. So the long-term backdrop here is robustly bullish. And I want to point out that your panel today is largely diversified. That's a new phenomenon. It used to be that most royalty companies were solely precious metals focused, and they had a little bit of base metals within their portfolio. They didn't talk about it. Nowadays, people are happy to discuss their base metal exposure and battery metal exposure, as evidenced by the gentleman on the call today. And that's an interesting new paradigm within the mineral space, and it shows the dynamics of the demand across the planet for elements across the periodic table. And we love precious metals, we love base metals, we love battery metals, and the outlook for the consumption of all these is robust. But that's looking forward on a half-decade to multi-decade timeline. The downturn that we're in right now is something that's occurred over the course of a handful of months or a year and a half or so, and there's a disconnect between that thinking. And as Rick Rule says, utilize the cycles in the business to your advantage rather than be utilized by the cycles. And this is a great example.
It's funny because I love copper right now. Copper for me is definitely going to be one of those key metals. When you look at the battery metals, clean energy metal space, basically didn't exist 5 years ago. And if you look at the forecasts and the projections, we're supposed to be basically cannibalizing the oil and gas sector, which is traditionally about 5 times the traditional mining sector. So there's a lot of growth to be happening. But copper is very interesting. We look at the zinc market. Everybody's been talking about zinc prices. They've been hit significantly over the last couple of months. I saw an article this last week that zinc stocks have gone down to a few hours global consumption. So that's not even looking that far ahead. But copper, we've been scouring the planet for every good copper deposit we can find. We're making way less discoveries. It's compound growth, right? To Dave's point, the reason why we're using so much more copper, where you get those kind of crazy statistics, is it's compound growth. So you're growing on top of the growth you had the year previously. And so when you're already at 4 million tons, next year will be 4.4, then it's going to be 4.88. So it's an incredible growth profile as we move forward. I think it's a really a new space, honestly. I think it's going to be a new paradigm for the mining sector as we move forward.
Well, yeah, I think Goldman Sachs would agree with you. Copper is the new oil. Fred, if I come back to you, if you don't mind, with regards to what Dave said, you talk about having a diversified portfolio. I know you're kind of heavily skewed towards the precious metals, but you are nevertheless diversified. Do you think that's enough? What else do you need to be able to talk about to claim to be a company with strong fundamentals, a company that people should be looking at in times like this?
I think we talked a lot in last year, 2021, as Elemental specifically. We talked a lot about our largest royalty at the time coming on stream at the end of 2021, going into 2022. And I think what we always said at the time was we had reached that inflection point where our margins were going to increase dramatically as we got more revenue. And I think people will want to see that. And they will say, Elemental, you've had a few years building the company from scratch. You have, I think, got an 80% compound growth rate on the revenue since you've started. And now we want to see that translating into more revenue, more free cash flow. So that's point number one. And the second point, I think, which you won't see in the financials, but it is, I think it's crucial for sort of investors looking at it over the medium term and looking at value, is the two biggest royalties Elemental had prior to this deal were both very new mines. And both of those are undertaking exploration. And we have said previously that we think there's going to be a lot of exploration upside coming at those assets. And so I think what we'll want to be showing investors, and we rely on the operator putting out the results and updating the market themselves, but what we'll want to be showing investors is look, these are not assets that had a 10-year mine life and will then stop mining. These are assets that had a 10-year mine life, and we hope in 10 years we'll have another 10-year mine life. And so if we can start to demonstrate that resource replacement at no cost to us, that optionality and upside on the exploration, alongside improving margins, that I think is what investors really want to see, because what it shows is you have made good acquisitions, and over time, the returns of those acquisitions, and I think this is generally on the royalty space, on good acquisitions, the returns get better and it looks better over time. because over time you never invest any more money in those assets, and you get all that optionality and upside.
Right.
And we do a lot of near-term development opportunities. And, these are really capital cost decisions about how much exploration do you do, when you're building a mine. And so a lot of the time we know that there's going to be a much larger resource, but they've got enough, to make a go of it. So they build the plant, they get going. But, sometimes we're expecting, 2 to 3 times growth. And so, these mines may have an initial 10-year mine life. But you ask, why do people like royalties? Royalty can be up to, 30, 40 years. It's just an income stream. It costs you nothing moving forward, and you don't have to do anything to manage it. It's just cash flow incoming. And so, to Fred's point, that continuation of that too is it's just kind of gravy on top.
And Dave,
there's an example if you'd like to review this. Yeah. Oh, thank you, Matt. What the gentlemen are talking about is very real. It's a concept of multiplicative optionality. When you own royalties, you're exposed to commodity price optionality, which we all love, of course, over the long haul. Although there can be periods of time when it goes the opposite direction. Options move in both ways, but there's also discovery optionality, metallurgical advancement optionality. And a great example is the royalty that made Franco-Nevada the largest and most premier royalty company out there in the world today. And that was a royalty they bought out of the Reno Gazette-Journal paper. This was a royalty advertised in the local paper. They bought it for a little over $1 million. It's now paid right at $1 billion, and is a great example of multiplicative optionality. And because lots of discoveries were made, new metallurgical techniques were invented, new engineering techniques enabled them to go underground, et cetera, all to the advantage of the royalty holder. Now, every royalty is not going to go from $1 million to $1 billion, but it is illustrative of this concept of embedded optionality within a royalty portfolio.
Right. Okay. Well, the question I did want to ask you about, Dave, because whether you're doing prospect generation, whether you're doing royalty origination, whether you're buying third party, or whether you're investing in other companies' equities, all of which you do, you've got to have a view on jurisdiction, right? A lot of conversations going on at the moment, but most companies come on here and go, "Hey, we're operating in a tier 1 jurisdiction." Tier 1. I'm not even sure what that means anymore, because there's so many roadblocks in every jurisdiction that I can see. What does it mean to you, Dave?
Well, there's a saying, rocks don't change, governments do. And, that this is one of the beautiful aspects of having a diversified portfolio globally, is you can, spread that risk across. There are some phenomenal places to work, I think, are very stable, such as Sweden, but even Sweden has issues. And there was a discussion previously about a lack of discovery in the copper space. It's fascinating. One of the biggest hold-ups with respect to new copper production is actually obtaining social license and permitting and governmental approval of the development of these large mines. And of course, it's quite ironic that the very people that are lobbying against global warming and want to electrify are the same people that are standing in the way of new mineral development. So there's a bit of irony in that. But there's a lot of what we call political ore out there, and that are large deposits that are awaiting development. And this is the Achilles heel of the mining industry in general, and will provide, unfortunately, greater price elasticity because of holdup of new development, and also delays capital expenditure within the sector. So these are very dynamic aspects. I think the way to handle that is you just want to be exposed to great geological terrains and great deposits. And we don't bear the direct brunt of the risk associated with that portfolio. Of course, long term we do, because if the project is not developed, then we don't get the cash flow.
Do you agree with that, Fred? I mean, are you worried about the kind of construct of your new portfolio? Is that a big part of the discussion? Or do you think we think long term? As Dave says, rocks don't change, governments do. It'll work itself out.
Well, I think one of the benefits of this transaction was it diversified us across even more countries, even more jurisdictions, and I think it's sort of, sometimes it's too simplistic to say this country is a tier 1 jurisdiction and this country isn't. You break it down by regions, you break it down by commodity. I think there are some regions and some countries where it's much easier to build a uranium mine than it might be in some of the tier 1 jurisdictions. So it really is, I think you need to sort of get into a pretty specific conversation. Suffice to say that what that means for us is that choosing jurisdictions where there is proven mining industry, a history of mining, and we diversify ourselves. And that puts us in a the best possible position. You can never predict the future, but it puts you in the best possible prediction. And coming on to your point on optionality, which was one I really wanted to touch on just when it was being talked about earlier, because I think investors often get very focused on the next year. Naturally, we do. I do. Sometimes I find myself doing it, but it's if we look across it at a longer term history. And on a long-term basis, I mean, I'll use one of our royalties as an example. The royalty we have at Endeavour's Wangyong, it started life as roughly a 2 million ounce resource when they built the mine at the end of 2019. And Endeavour, top 10 gold miner globally, have publicly come out and said they are targeting an additional 1.5 to 2 million ounces by 2025 on that asset. So it will have, if they do that, it will have a bigger resource in 2025 when we should be just about fully repaid on the royalty than it did when we bought it. Now, do we get valued on that today? No. We get valued based on the reserves, or maybe we get some upside, some optionality on it. But I think that the key thing is, as time goes by, as you are able to demonstrate some of those features of optionality that David referenced earlier, I think it gets easier and easier to make the case to investors. Because when you buy a royalty on day one and it has a 10-year mine life, everyone models it out for 10 years and goes, okay, great, that's it. But the reality is, would we sell that royalty from year 11 onwards for $1 million? No way. Would we sell that royalty uncapped from year 11 for $10 million? No, we wouldn't either. And actually, if you think about it like that, if you went to a lot of these royalty holders and said, we'll buy your royalty for $1 million from you from the day it's due to stop mining, I think most royalty owners would say, no, get lost. I'm here for the optionality. I'm here for that upside, and I have no holding cost. So I can sit there, almost no holding cost. I can sit there and I can aggregate these into the portfolio, and I can get multiple optionality across multiple projects on multiple different levels. And that is what investors really like to see. And when you look at the big royalty companies who've been around the longest, they can demonstrate it because they've had some of those royalties for a decade, for 2 decades, and they can really prove it. I think when you're a younger royalty company, it's actually harder to do because you don't have that 3, 4, 5, 6 years of holding the asset to be able to demonstrate the resource growth, to be able to demonstrate the embedded optionality. And that's why I find we often talk to some of the examples in the bigger royalty companies, not because we don't necessarily have that ourselves, but because those royalties have been around longer. And so they have more history to them. And it's a more demonstrable track record of the optionality. But that same optionality should apply to all the royalties that we sitting in this room today, or these different rooms today on Zoom, can have in our portfolios as well.
It should, and I think here's the thing that's kind of missing in this is obviously lack of understanding of how to value royalty companies more broadly, because there's too many moving parts. I haven't got enough time, or maybe not necessarily the skills to do that. Says the average retail investor. But they're also looking at the real life, the reality of the world at the moment, which is increased costs, inflation, etc., which you guys have been talking about obviously for the last year, I suspect, with supply chain issues and so forth. And they're concerned about, how does mining kind of survive this? So I've even had CEOs come on here and say, I am leaving, I'm going to say Nevada, because my all-in cost, including the toilet roll cost for per meter, is now at $800. I can't make this work. I can't do what I need to do because I can't raise the money I need to raise without absolutely crushing my company. I'm going to have to go somewhere else. So those real world costs on explorers, the lifeblood of future projects, which I know you guys get nearer production type royalties, or that you prefer to do that. But if that's what's happening at the grassroots, and you've got investors looking at scenarios like that going, well, the explorers can't actually afford to do what they're meant to be doing. Maybe I need to be looking at another sector because there's massive disconnects everywhere. How do you feel about that, Dave?
You can't change the demand curve, and those metals have to come from somewhere. So the cure for low prices is low prices, and the cure for high prices is high prices, and the capital markets will react. But we all know that they can be short-term quite inefficient. And it comes back to the saying, utilize the cycles to your advantage rather than be used by the cycles. and not to sound repetitive, but it comes back to that key point. The mining business is a tough business. Being a producer and being an Explorco is an absolutely grind, and we've all seen that throughout our career. It's enjoyable to be on the royalty side.
To today's point, I'm still the only full-time management employee in our company right now. And we've probably had 1,000 people working on our assets this year, hundreds of millions of dollars going into it, all at no cost to us. So it's much easier. We can be a little bit more relaxed about it. It's not easy though. Mining is a different industry, and the short sight, it's, looking ahead is going to kill us because it's an average 15-year development timeline. From, you tell me you need 10, I go poke a hole. Wow, we're so lucky. I found some, I might be able to get you some 15 years from now, because that's how long it takes. And especially like you mentioned with the social, the environmental, there's a lot of copper deposits in BC, pretty big that could probably make a good dent in some of our future demand. But permitting has just been stuck for, in some cases, 10, 15 years. You saw that big lithium project in Serbia with Rio Tinto. There's a lot of that out there. So it's tough. You can't have that short-sighted thinking. I think for us who have been in the industry, you understand how it works. We feel like we're kind of yelling as crazy people here, trying to tell people just exactly, what the situation is. But there's so few people out there. Our industry has been gutted over the last 10 years. So there's so few people out there, I think, really understand the supply-demand dynamics and really, the realities of the supply side for each of these different metals that we're targeting.
Okay, well, that's very comforting, and therein lies the opportunity. I think you'd say to everyone listening in or watching this. But let me give you both. I'm just conscious of your time now. When I give each of you an opportunity to sell your own projects, give you a minute and a half. Fred, do you want to go first?
Absolutely. Well, look, I think that the key story with Elemental has been, since we listed, it has been build a foundation of producing royalty companies, and that lays the basis for you to go out and build your pipeline. And that is what we did. I think that's why we attracted an opportunistic hostile takeover bid, because we had built a portfolio of genuinely attractive cash flowing royalties, high quality ones. And the merger that we just announced at PDAC this year with Altus Strategies, it is putting two very similar companies together. We have a portfolio that's 75% gold weighted with about 20% exposure to copper. We have a portfolio of royalties that is over 80% weighted towards producing assets. We have revenue that is getting up to nearly $20 million this year. We had, I should say, $150 million market cap. It's significantly, as a pro forma combined entity, it's significantly less than that today. So you're coming into a company that has grown its revenue, I think on an overall over 80% compound basis, just as Elemental prior to this deal. We're going up to forecast just under $25 million of revenue next year. And you're currently at the share price today, it's probably an equivalent of 8 or 9 times revenue. So it is the lowest value we have ever traded at, either as Elemental as a public company. But I think, when you look at the multiple as well, for the combined group, it's the lowest market cap we have as well. And when you think that on the flip side, we have more assets than we ever had, we're more diversified than we ever have, we have more revenue and we'll have a bigger margin than we've ever had. We have a much bigger development portfolio from Altus, and we haven't even talked about the royalty generation side that they have embedded in their team. So I think for all of those reasons, we are the best value today that Elemental has ever been since we listed the company. And I think that if we were sitting here saying that 6 months ago, I would have said it's a great buying opportunity. But sitting there saying that today, having had someone come in and pay or at least offer significantly higher than where we're trading today, I think a sort of 50% higher share price, at least nominal bid for us to take the company over, and having just merged or announced a merger, I should say, with Altus, where we're materially increasing the portfolio size of the company, the assets, the shareholder base. I think all of those things combine to make Elemental the most attractive that we have certainly been since we listed the company today.
Thank you. Dave?
We touch 5 million acres of mineral rights worldwide, Matt. And we've been building this portfolio for 2 decades, largely through royalty generation and also key royalty acquisition. There's some catalysts within that portfolio that are coming to fruition within days. And we expect the Gediktepe gold royalty, gold and silver royalty in Turkey to start cash flowing any day now. They just crossed the threshold of 10,000 ounces before they start to write us checks. So we're looking forward to that. The Leeville royalty, operated by Barrick on the Carlin Trend, the site of robust discovery on behalf of Newmont and Barrick, part of that joint venture, is cash flowing nicely for us. And then a great example of optionality within the copper space, and we're all copper bulls, is the Caserones mine in Chile. That's cash flowing to us right now after tax, just under 8 million USD per annum. And they just announced that they increased the reserve there from a 17-year mine life after having mined for a year. So it should have gone to 16 to 28-year mine life. That's a great example. We love to be exposed to those long-lived assets. It's like having a 30-year bond that pays in pounds of copper. So we're delighted to be exposed to that royalty. Altus is also exposed and was a participant in a syndication purchase of that royalty with us, I'll point out as well, to Frederick's account. And I could go on about the portfolio and the catalysts within that portfolio, but it comes back to these concepts that we have been discussing about the embedded optionality within these portfolios and the exposure to mineral rights globally.
Okay, Brendan, why don't you take us out?
Yeah, sure. So, we have a portfolio of 20 royalties. We're diversified across all of the clean energy metals, which have exponential growth forecasts moving forward really over the next 2 decades. We have a producing royalty. We've got a number of royalties that we've been buying into over the last couple of years that are heading towards production over the next, kind of 18 months. $150 million was just raised to put our lithium royalty Oche into production in 2023. We have a past producing graphite mine, Graph Mata, that they've stated they want to bring that back online to production over the next 9 months. And our Bissett Creek asset, the operator, is now the 3rd largest graphite producer outside of China. And they've said they want to make that their flagship. So, we've got a number of royalties we picked up over the last couple of years. They're going to be entering production to get us, diversify our cash flow. But we're going to have a lot of cash, pro forma about 8 million. And we're trading, as if our royalty portfolio is worth next to nothing at this point. Our enterprise value is, around 5 million as of taping this. So, all the upsides from here, as far as we're concerned. And, we've had about $400 million go into our portfolio over the last 18 months. And that's all being done, at no cost to us. So time is going to solve all of our problems as we move forward here.
Gentlemen, look, thank you very much. I feel invigorated now. I better get out there and get my contrarian buying boots on. Okay, so thank you very much today to Brendan Urick, Dave Cole, and to Fred Bell for enlightening us as to why royalties are indeed a good addition to your portfolio if you haven't already done so. Thank you, gentlemen.
Thank you, Matt.
Thanks a lot, Matt. Thanks, Fred, Dave.